This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Josh Wein. Josh, thanks for coming back on Viewpoints by Hennessy.
Thanks, Jay. Good to be with you.
All right, let's get right to it. On a recent CNBC appearance, well, it wasn't that recent. It was back in February, but just stated that the next 2 years are going to be more about earnings rather than rate hikes. How are you looking at earnings and forward guidance today?
Yeah, I think that, first and foremost, rate hikes have been front and center for a while now, and certainly rates went down to near zero, and now they've come back up to the point where, the 2 years at about 5%. So that's kind of a big development over the last 12 months. I think where we stand now, and why I think your question is quite relevant, is that the market as a whole is not pricing in a rate cut for at least a year, and really not even pricing in a high probability of a rate hike. And we'll see what happens in the next several months. But I think that, where we are in the cycle, the economy is slowing, maybe not going into a recession, but certainly slowing. And we're hearing bits and pieces as companies report earnings. And thus far this quarter, revenues have grown just barely above zero. I think it's less than 1% in the aggregate from companies that have reported. But we've seen earnings come in. And as a result, that would imply some margin compression. So I think that kind of good old fashioned earnings fundamentals will rule the day for a while until we get some more clarity around rate hikes or cuts.
All right, Josh, let's zoom in a little bit and look at sectors. As you look at the sectors today, are there any that appear to be undervalued to you?
Yeah, I think that, one thing that sticks out to me is energy. I think that sentiment certainly is not in favor of energy, despite some strong fundamentals of late on the commodity side and some of the results that these companies have posted. I think that there is still this idea that energy, is in the crosshairs of lots of, groups that would love to see it go away. And I think that, the market, the more that, one looks at energy, the more one thinks that the market is pricing in this idea that energy just goes away sooner rather than later. And I think that whether it should or not is irrelevant. The point is that, energy will be with us, for a while, the energy sector and, exploration and production and the like. And these companies have posted strong results. And despite some recent softness in the price of oil and natural gas, I think that, the thesis remains that these companies are generating, free cash flow and are able to pay dividends and buy back stock. And that is a compelling theme in this environment.
As a portfolio manager, are there any other sectors that you have your eye on today?
Well, utilities haven't really participated in the rally throughout this year. So I think utilities are always interesting. Just their business models lend themselves to predictability and stability. I think they get overlooked as just a yield play. I think mainly because the revenue and earnings growth is not never, but it's very often not a double-digit type story. It's more kind of the 5%, 6%, 7% growth. But I think that over time is exciting. And I think that, utilities on the backup in rates, utilities have sold off this year. And I think that, that can't continue for much longer, I would expect.
That's a great segue into our next question. So rates have been on a tear. The Fed has gone through the most aggressive rate increase cycle in history. As a portfolio manager, how does this impact your thinking going forward?
Yeah. So, as I mentioned earlier, we have a 2-year treasury that yields 5%. And so there is competition for capital. As inflation comes in, that 5% actually represents a yield above the rate of inflation. So I think that there was a time not long ago that, equities in their totality represented an incredible value just because there was either yield or growth or both. And, government bonds, paid, very little and certainly well below the rate of inflation. Now, here we are in 2023 and that's really reversed. So I think that, it doesn't directly get imparted in the way that we look at things in terms of stock selection. But I think it goes without saying that investors now have choices. And I think as a result, there will be more attention placed on individual equities. It won't be this big beta bet on all things equity. It will be, is this worthy of ownership? Are they growing? Are they able to control costs? What do their margins look like, and things like that.
Yeah, the impact of active management is already starting to come to fruition again.
Exactly.
So, yeah. All right, so let's pivot and talk about mid caps. As an investor and portfolio manager, where do you feel mid caps fit in a diversified portfolio, and why?
Yeah, I think they always fit, and certainly now, like utilities earlier, mid caps have really not participated in this most recent rally, and I think that they always deserve a place in a portfolio. There are a lot of great companies, very solid companies with great access to capital, and I think right now, growth is hard to come by. So one thought is, among others, that this idea of M&A, and so mid cap companies represent an attractive way for larger entities or equal size entities to buy growth, through M&A activity. So I think that it's not a call on M&A necessarily, but I do think that over time there will be some activity. There's certainly a lot of dry powder on the part of strategic buyers in the form of S&P 500 type companies. Certainly, though, also plenty of dry powder in the hands of private equity firms that need to deploy that capital in order to earn a fee. So I think that there's an M&A story, and I think what supports that as well is the idea that large mergers and acquisitions are being scrutinized more heavily in this administration. So I think that a mid-cap deal kind of flies under the radar a lot more easily than a large cap deal.
Yep, that's right. Let's pivot and talk about your fund.
Sure.
You're the co-portfolio manager of the Hennessy Cornerstone Mid Cap 30 fund. Now, this fund has delivered some very impressive performance results here recently. Josh, what do you think has driven this performance?
Yeah, it's interesting because when you look at the construction of the fund, and we can talk about that in a bit, but we look at valuation, earnings growth, and stock price momentum, and those are three factors. So when you do factor analysis, quantitative kind of factor analysis, over the last 5 years, the factor that has contributed the most to returns is valuation, and more specifically, the use of price to sales ratios. So I find that interesting because it is non-traditional to use price to sales. And I think what has helped just anecdotally are, companies over the last several years that have turned the corner back to profitability. And so price to earnings, the more common measure of value, is going to miss a lot of those names. When a company swings from a loss to a profit, and maybe they're making a penny or two, and the PE is 100 or 200, or maybe it's almost infinite, a lot of investors shy away until earnings return to normal. And I think price to sales captures some of those recovery stories, and so that certainly has served the fund well, among other things.
Josh, between Neil Hennessy, yourself, and a lot of the other portfolio managers at Hennessy, we could do a whole show just on the importance of price to sales and active management. Clearly,
it is interesting.
Yeah. All right. So let's dig into the fund. What is the portfolio construction process for the Hennessy Cornerstone Mid Cap 30 fund?
Yeah. So our universe is, market cap between 1 billion and 10 billion. And we're looking at companies with a price to sales ratio below 1.5. We're looking for year-over-year earnings growth, and we're looking at 3 and 6 month price momentum. So it's a very disciplined approach. We are not getting in the weeds on the merits of one company versus another. We're letting the data dictate, our sector and name selection, and it's very straightforward. And we rebalance or reconstitute the fund on an annual basis in the fall. So we rerun the numbers and see what comes up. And from year to year, there will be 4 or 5, maybe 6 names that stay, and the rest are new names.
So, Josh, does that mean the risk controls in your portfolio are 100% rules-based and removals only come as a result of a rebalance?
That's right. That's right. And in some ways, that kind of rules-based risk management, if you will, I think saves us from ourselves. So sometimes, there's bad news, there's, geopolitical events. And I think a lot of managers, understandably so, say, hey, I think it's time to go to cash, or let's lighten up, or or load up on a name, and we don't do that. And I think it serves us well. I think that the emotions of investing lead us down a path of overactivity and overstimulation and some bad decisions in the heat of the moment. And so we don't deal with that dynamic at all.
Yep. Just like investors, portfolio managers have emotions too, don't they, Josh?
Oh, absolutely. I think maybe more so. Yeah.
Let's dig into a couple of the holdings in the portfolio. So what is the investment case for your largest holding, Super Micro Computer?
Sure. Well, Super Micro, as mentioned, came into the portfolio as a result of valuation, earnings growth, and some stock price momentum. I think what's interesting, Super Micro has caught a bid of late due to their, they make servers and storage products. And so they have been able to ride the coattails of this frenzy that we are all living in called artificial intelligence, or AI. And so they are a major supplier of the equipment that enables AI. Running those algorithms takes a lot of equipment and capacity and storage, and Super Micro Computer has been able to, participate in that excitement.
So Josh, Academy Sports and Outdoors is in the portfolio today. What do investors need to know about that holding?
Yeah. So, again, a great valuation and earnings growth and stock price momentum story. I think Academy Sports is interesting because, it lives in the shadows of Dick's Sporting Goods, which is a much larger, peer of theirs. Academy Sports is smaller. It's in about 18 states, growing their footprint in a very robust way and great, store level economics. They do a great job merchandising, slightly lower price points than a Dick's. And, for budget minded consumers, I think it resonates. So a very interesting story that doesn't get a lot of attention.
Josh, thanks for coming on Viewpoints by Hennessy. Viewers, to learn more about the Hennessy Cornerstone Mid Cap 30 Fund or any of the mutual funds in the Hennessy lineup, visit hennessyfunds.com.
Thanks, Jay.